The S&P 500 closed about flat here today, but don't let the end performance confuse you. We had fireworks here today. Within about 5 minutes of the opening bell, we had some huge companies like McDonald's and United Healthcare, Union Pacific, and others with exaggerated movements, sometimes to the upside, sometimes to the downside, but they basically had to halt dozens and dozens of companies because of very wild movements out of the gate here this morning. So after the dust had settled there, as a result of some of the software glitches and other things that they were dealing with at the New York Stock Exchange, things basically calmed down. Now, after hours here tonight, we did find a few more fireworks with stocks like Microsoft and stocks like Texas Instruments, Intuitive Surgical reporting earnings after the bell. Also wanted to announce the new companies that were added to the 2023 Dividend Aristocrat list. There were 3 new companies, so we'll talk about that in tonight's video as well. And then we'll wrap up with a trade application example on a company that you can probably see a lot of evidence of on my shelves behind me here. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 24th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these different videos here on YouTube. We'll usually send out an email shortly thereafter. Remember, at the bottom of those emails, we also give you a heads up if there are any stocks that are giving you overbought or oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. We certainly appreciate those of you that follow us and also click like and retweet on these Market Outlook related posts. And then last but not least, we have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And it was a very interesting day, I must say. I taught my dividend growth investing class this morning. We talked about a couple of things that were going on in the session. And for those of you that didn't catch it, the stock market opened with some fireworks. And they were unexpected fireworks. There were a number of glitches and errant trades that were taking place on the New York Stock Exchange. I think I heard somebody on TV say that it was like 84 stocks or something like that that was affected. So there were a lot of them, and it wasn't just unheard of companies. There were a number of well-known large cap, mega cap types of companies that were affected. In fact, maybe this would be a good idea to come over and actually just show you some of the candles today to make you aware of it. Let me pull up just a regular swing trading one grid here, and I'll give you a sense of things. Let's take a look at McDonald's. Look at this candle on McDonald's here today. That does not look normal because it looks like it gapped down to start the day at 236 and then went all the way back up to 269 by the end of the day. Another big one that was affected was Union Pacific. You can see how erratic that particular candle looks, where this one gapped the other direction. It gapped the day up and then finished the day lower. UPS was another one that was impacted. Again, look at the exaggerated candle there of a gap down only to basically gain back all of those losses. We're talking about huge moves here, by the way. You'll notice 157 was the low and it basically closed at 180, right? So we're talking like $23 worth of range there in this one company. United Healthcare was another one that had a wild range day there today. Another one was a lesser known company, but some of us in the dividend growth investing community followed a little bit more closely. This is a real estate investment trust that owns much of the property on the Las Vegas Strip. This is Vici Properties, and you can see again, look at this exaggerated candle where it basically opened up down here below $29 and closed up here close to 34. Even Verizon, obviously one of the biggest telecom companies on planet Earth, had a range today between $32 and $44. And I could go on and on and on. There's a whole bunch of stocks that were impacted. And what basically happened was apparently there's this kind of auction process that takes place before the formal opening bell, which basically teams up buyers and sellers together to basically set an opening price. But for some reason, those auction results were not delivered to the powers that be on time for the opening bell. And so by the time the opening bell rang, there were all kinds of movements up and down without that normal process in place. So as I go to press here, they weren't sure if it was a software glitch. They say sometimes they're kind of reinstalling software or what's happening, but it was quite a dramatic impact without a doubt. But typically what I have found to be the case so far, I did converse with one person on Twitter who was fortunate enough to get some shares in Vici filled before they halted it. I actually tried to place a trade on Vici myself after I saw it was down like 11%, but because it was already halted by the time I put in my order, as soon as they unhalted it, it went right back to yesterday's closing price. So if you were lucky enough to have some trades in on those specific stocks before they were halted, you might have been lucky enough to get filled. But most other people that saw it after the fact, unfortunately, did not get so lucky in that case. And I also heard them say on CNBC that there's a possibility that some of those trades could end up getting busted or broken up, and basically saying that they weren't due a fill at those prices. So it was interesting. You don't see those days very often. Some of you that have been with me long enough will recall that back in 2015, there was a very interesting situation similar to that. And my class dividend growth investing portfolio was fortunate enough to get filled on 5 different stocks at quite good prices. Of course, 3M these days, not quite as good as it used to be, but a lot of these other ones, Automatic Data Processing at $65, Texas Instruments at $44, Target at $73, and John Deere at $77. This all happened back on August 24th of 2015. That was a flash crash day there as well, but it was a little bit different than the one this morning, because the one this morning basically immediately halted. I mean, within like the first minute of trading, everything just froze up, so you couldn't really take action. Whereas the one back in 2015 and also the one further back in 2010, when Procter & Gamble was down like 20 to 30% within a half an hour, those were happening during the normal market session, so people could actually go in and try to get filled on trades. Reporting back of the trades from the brokerages were not always as efficient as some people wanted, but there were actually trading opportunities to be had on those very erratic days in the past. But today, I would not classify it that way. Today, you had to be very lucky to have some buy limit orders not too far down, but maybe like 5 to 10% down on just those 84 stocks or whatever it was that got impacted here today. So that certainly, provided a few more fireworks this morning than what we are typically used to on boring old Tuesday mornings, and had a good conversation about that in my dividend growth investing class here earlier today as well. For those of you that missed it, you can check that out on the recording. Anyway, let's get back to our normal routine here and see what happened with the S&P 500 heat map. So this will show us not the dramatic movements of the open, but this will show us how did everything close up at the end of the day. And so it was kind of a split decision today. We actually saw a little bit of volatility both on the upside and the downside. Of course, we are heading into earnings season. And by the way, Microsoft reported their earnings tonight. They were one of the biggest tech-oriented companies to come out with their numbers. And of course, we'll have several others as we go forward, not just this week, but next week as well. But initially, Microsoft went up about 4% after hours here. But as I just looked a moment ago, all those gains have now evaporated, and it is now basically back to break even from where it closed here today, or perhaps even a little bit lower. Texas Instruments also came out with earnings tonight, and it was down a little bit, not a dramatic plunge. And then Intuitive Surgical, the robotic surgery company here in the United States, with their Da Vinci systems, that's been a great growth stock over the last decade or two. It came out with earnings tonight as well. Unlike the other two I mentioned, that one did come down pretty hard. It was down like 10 or 11% the last I looked. So keep in mind, we're going to start getting into the heart of earnings season here, and we're going to be seeing a lot more exaggerated moves both up and down. And remember, for those of you that want to keep up to date with that information as we head towards the opening bell, I would invite you to check out the 9 at 9 that I produce every morning, both on the Market Scholars website, and then I also post it there on Twitter. And what that is designed to do is to let you know a half an hour before the stock market opens which stocks are most likely to be up dramatically and which ones are most likely to be down dramatically. And typically when we're in earnings season, that graphic gets a little bit more interesting, right? When we're not in earnings season, then you kind of have random news stories about stocks getting bought out or maybe a brokerage downgrade or something like that that might affect the prices. But right now, the biggest driver of prices will be the reaction to earnings reports. And so if that's important information for you, that 9 at 9 is something that is free and available to all of you, whether you're a subscriber of Market Scholars or not. So make sure you check that out on our website under the blog area. Anyway, back to the S&P 500 heat map here. You can see Microsoft actually closed the day flat. It was down 0.22%. So keep in mind that does not include the after hours activity I was just mentioning a moment ago. Initially, Microsoft went all the way up to about $253. You can see here it closed at $242. So just to put that into perspective, it went up about $11 per share after hours. But as I just mentioned, it gave all of that back here within the last 10 or 15 minutes. So we'll see if things change before tomorrow morning. But right now, it's kind of looking like it's going to open up right around where it closed. Some of the other movers here that catch my eye, of course, Google was in the news today, or Alphabet as they call it these days. It was down about 2% here today, and it sounds like they're continuing to go through some lawsuits and some monopolistic practices and things like that. Of course, they've been dealing with those types of issues here for quite some time, but they received some new information on that front with their advertising practices here today. So market wasn't too enthusiastic about that and sending that mega cap company lower by about 2%. You'll notice that Amazon was down 1% here today as another one of those mega cap players out there. A couple of the stocks that I had mentioned that were taking very exaggerated movements within the market today. UNP, so this is Union Pacific, a big railroad company, was down about 3% here today. I did just mention here on Twitter this afternoon after the closing bell that a couple of UNP's competitors, Canadian National and then Norfolk Southern, both railroad companies, raised their dividends after hours here tonight by about 8 or 9%. So that particular area might be in focus tomorrow in the dividend community. You'll notice that 3M was down tremendously today. Now, this one was not one of those exaggerated movements as a result of the weird open. They actually reported earnings. And of course, 3M has been quite the disappointment here in the last 2-3 years, mostly as a result of the lawsuits that they're dealing with right now, both the groundwater lawsuit and then also what's been going on with the earplugs for the military members out there. So that stock seems to continue to struggle, sad to say, for us dividend growth investors. A lot of other stocks that were down seem to be, at least the bigger ones, were in kind of the healthcare space. You can see Thermo Fisher was down about 4% today. Edwards Life Sciences was down almost 4% today. All of your large cap pharma stocks like Merck and Pfizer and Bristol Myers all struggled here today. Lilly kind of kicked that to the other direction. Lilly managed to close higher by 1%, but it does seem like there was a little bit of extra selling there in the healthcare space. And remember, healthcare has been starting to struggle a little bit on a relative basis as more exciting sectors are starting to kind of pick up favor. And we'll talk about that a little bit later on in the presentation tonight when we look at the sector selector tool. In terms of those that found themselves on the green side of the ledger, you can see here that Apple was up about 1% here today. We saw United Healthcare, after that very exaggerated open that I had mentioned before, they did manage to close the day higher by over 1%. JP Morgan was up almost 1%. Bank of America up about 0.73% there. Looks like we had Berkshire Hathaway up just a touch. I'll actually be talking about that stock a little bit later on in the presentation. We've got Walmart up just a touch. Coca-Cola, Pepsi both managed to close higher, and ExxonMobil did as well. Home Depot was up a touch, and then Tesla was effectively flat. Of course, some of you have seen the news that Elon Musk has been in court this week over that tweet that he had so many years ago saying that funding was secured for his private takeover of Tesla. And so he's trying to wiggle his way out of whatever sort of responsibilities he might have had. It's kind of humorous to me that he now actually owns the entire website and platform of Twitter, the very place where, of course, he posted that note back in the day that the SEC is taking issue with. So it seems like Elon kind of tries to play by his own rules, and we'll see if he can make his way out of this one once again. It seems like the never-ending fight between the SEC and Elon Musk. You can see that a lot of the industrials were up today, so Caterpillar, Boeing, Lockheed Martin. I did notice that Raytheon was up quite a bit. Where's Raytheon? Is it that one? For some reason I'm not seeing it, but I do know that I looked earlier today and Raytheon was having a pretty good day. Where is it? There it is. Must have just been overlooking it, but it's up 3% today. So that was one of the bigger movers there. PCAR or PACCAR was up very nicely here today as well. So it seemed like we did have some nice strength there in some of the defense contracting areas. It sounds like after the bell tonight, I heard more news about Russia and Ukraine heating up once again, and so there's a possibility that more weaponry is heading towards that part of the world, and perhaps Raytheon and Lockheed Martin and Northrop Grumman and General Dynamics will benefit to a degree from that as well. All right, let's go ahead and now check the breadth numbers back here on the main part of the platform. And I've got the S&P 500 pulled up here in the Market Watch Visualize area, and you can see that 227 stocks in the S&P 500 managed to close higher today. So that's about as split of a decision as you're going to find. It's about a 45% hit there for the bulls and a 55% drop there for the bears in terms of winners versus losers here today. All right, let's go ahead and now take a look at our 4-grid analysis. And let's go ahead. And by the way, let's take a look here real quick because things change awfully quickly in the after hours. So let's take a look at Microsoft here while we're at it. So I can just kind of emphasize what was taking place earlier in the after hours session when they reported their earnings. It's a little bit hard for you guys to see, so I'll do my best to kind of explain what I'm looking at here. But here where I'm circling my mouse kind of in the lighter part of that miniature chart in the middle is basically where Microsoft closed at basically $242. And they are one that they release their earnings almost immediately when the market closes. Remember, Apple does not do that. Apple, when they report their earnings next week, they usually report their earnings about a half an hour after the market closed. But Microsoft, pretty much as soon as the closing bell hit, they immediately reported their earnings. And so we get to know right away how the market will react to that. And initially, the market must have loved what they saw because you can see the price activity went all the way up to 254. And it wasn't a fluke. Sometimes you have these erratic movements up and then it's immediately unwound. That was not the case here. You can see Microsoft actually held these gains for approximately an hour and a half, maybe even a little bit more than that. But then right around here where I'm circling, it started this slide and ended up giving back all $11 and is actually down just a touch right now, trading at around 240 in the after hours session after having closed at 242. So it went from 242 up to 254, back down to 240 here. So kind of some crazy movement there. And then I mentioned Texas Instruments as well. And you can see right here that Texas Instruments is trading at about 175 after hours. This one was a little bit more herky-jerky after hours. You can see initially it went down to like 173, then rebounded all the way up to 181, and now has unwound those gains and kind of settling in here just $1 or so below where it closed. Let's go ahead and also take a look at Intuitive Surgical, ISRG. and you can see what I had mentioned before, that this stock is down tremendously from where it closed the session here today. It closed at around 258 and currently trading at around, let's call it 233, somewhere around there. But it had gone down as far as 212 in the initial pullback after releasing their earnings. So, again, there's going to be a lot more of where that came from. Keep your eye on some of your favorite companies. I think I even posted on Twitter over the weekend a lot of the main dividend growth investing types of companies that'll be reporting earnings here this week if you're kind of interested in that type of information. All right, let's go ahead and take a look at our traditional four-grid now. And the S&P 500, as you can see, was down just barely here today. Not by much. You can almost call it flat, but technically it was down 0.07%. The Dow Jones was up 0.31%. The NASDAQ Composite was down 0.27%. And the Russell 2000 was down 0.27%. So it kind of cracks me up that we have these range labels on the charts, as many of you are aware. And when they're blue like this, it basically means that the range was cool. Think of the color blue or light blue associated with cold, like on a faucet handle, right? Whereas red would be associated with hot. Blue would be kind of cold. So think of this as calm. And then if it's ever orange, then that means it was a wild or hot day. Think of the color of fire associated with orange. Of course, we use the blue and the orange a lot, quite a bit here at Market Scholars, because that happens to be our corporate colors. But you'll see that today, all four of our major U.S. equity indices have blue labels, meaning that their daily range today was very quiet compared to their average true range when you go back over the last few weeks. But this is all happening on a day, like I had mentioned before, where we saw some of the most exaggerated movements you could ever remember for some mega cap types of companies. So if I were to pull up McDonald's as an example, notice right here that the label is no longer blue, it's now orange, and you can see that the daily range, if you were to count this actual candle, the daily range today on McDonald's was $33 per share, when its normal average true range is closer to like $4. And you could pull up United Healthcare and some of these others that I had mentioned before, Union Pacific and UPS. Notice orange labels, orange labels, orange labels, even Verizon, orange label, right? Verizon, a $12 daily range, when this is a stock that usually doesn't even move $1. So it's a little amusing to me that on a day when we had such violent movements on the individual stocks that make up the market, it was one of our quietest days on the index level. Anyway, as you can see, we did have a posture change to alert you to, and that is the Russell 2000. Notice the background color of the chart went from green to pink, and that is because this green line down below on the market forecast for the Russell 2000 chart fell out of the upper reversal zone. Now, it just barely did. You can see here in the label, it'll actually tell you what the reading is of that line, and the intermediate green line is at 79.66 and falling. So remember, when it crosses below 80.00, that's where that light pink background color can show up. So it's not a dramatic move lower, but perhaps telling us that it is now up at somewhat of a resistance area. And I think, as of this moment in time, I tend to agree with that, right? You have a fairly clear level of horizontal resistance here. If you were to get like a drawing tool out and just use like a price level, you can kind of see what I'm referencing here. If you kind of draw it over the tops of some of those closing candles right there, you can see time and time again in the past 3 months, this level where it touched earlier today happens to be a bit of a resistance area where sellers have stepped in the past. So We'll see if they continue to step in or whether this is just a momentary stalling out. As we've been talking about here in recent weeks, the Russell 2000 has actually been quite strong. And so there might be enough force and momentum behind the shares to kick us back over that prior high. Notice that the Russell 2000 is the closest right now for taking out its 3-month high, which is at 1905. So it would only need to go up 20 points from where it closed here today in order to take out that high from November 15th. Whereas with these other large cap indices, it's going to take a little bit of a bigger effort to get up and over those prior highs. They're not that far away from it, right? We've had a very strong market, especially Friday and Monday. So theoretically, multi-month highs could be taken out on all 4 of these charts, but it does appear that the Russell 2000 is the one that kind of had the biggest head start if it was trying to head towards that goal. So a little bit of a setback here today as that background color did shift back to light pink. But remember, if that green line could get back into the upper reversal zone, in other words, just pop higher by less than a point from 79.66 up to 80, then that would turn back to a green background color on the chart. So remember, when the shading is lighter like that, it's easier for that to become a head fake. Whereas when the shading is darker, then there's a little bit more substantial evidence. So for example, up above here with the Dow Jones Industrial Average, notice that its background color is that darker shade of pink because the green line has now passed through that indicator's 50th percentile. And so there's been more wear and tear on the chart of the Dow Jones Industrial Average, whereas there's been a lot more bullishness on the Russell 2000. So just a way for us to kind of, slice and dice the markets a little bit more finely when we're looking at that. The other 2 charts, by the way, continue to have strongly bullish postures. Notice the S&P 500's background is still that dark green color, as is the NASDAQ's. The other thing that I think is useful to point out is that 3 out of these 4 charts have green moving averages right now. So that would be the S&P 500, the NASDAQ Composite, and the Russell 2000 all now have green 30-day moving averages, which is telling us that price is above a rising moving average. And generally speaking, that is a bullish feature of the markets. You will notice the Dow Jones Industrial Average was actually at a green moving average yesterday, but today it went back to yellow. So in this case, what it means is price is above a falling moving average here. So again, the Dow was our big leader in the fall and winter, but as we headed into 2023, it has taken a back seat to the more exciting indices out there. Remember, the Dow is filled with the big lumbering giants of business, right? The big blue chips, the big bellwethers, the companies that don't really offer a whole lot of excitement. And they can serve your portfolio well, depending upon circumstances. Last year was a year when the Dow Jones really crushed the rest of these indices. We've talked about that a lot. In fact, I was talking about the Dividend Aristocrat list quite a bit here on Twitter earlier this afternoon because they just released the 2023 version. But I always say that the Dividend Aristocrat list, if you were to team it up with a high-level index in the United States, it's closer to the Dow Jones than it is with these others. And of course, last year we know that those dividend growth stocks and the big bellwether companies like Coca-Cola and Procter & Gamble and the like really helped both the Dow Jones and the Dividend Aristocrat list outperform the more exciting tech-oriented areas out there or the speculative small caps or what have you. So last year, the Dow was more times than not our leading index. Fast forward to where we're at right now, just 24 days into the new year, that's no longer the case. In fact, the Dow has taken the back seat. Now you can see that some of these more exciting areas are kind of leading the charge higher. So that's why we have the videos as often as we do here. Hopefully you get value out of not only watching these every trading night, but also following David and I's Twitter feeds where we try to keep you educated in what we are seeing in the markets. And then, of course, those of you that are premium members hopefully will attend our classes regularly during the weeks to gain our insight from that perspective as well, because the truth of the matter is things change, right? And that's why we need to kind of stay plugged in with those changes here. So anyway, it was a quiet day according to the end result of these indices, but I would not classify the trading activity today to be quiet on an individual stock level. In fact, quite the opposite. It was quite the exciting day, at least first thing in the morning. Let's go ahead and pop on over here now to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. And last time I did the video, remember I always pin my most recent market outlook tweet to the top of my timeline. So that way, if you just go to twitter.com/Brandon Van Zee, you will be able to see very easily which tweet it is that we would request that you click like on if you enjoy these videos and you want to support them and you want to say thank you to us. So thank you to the 109 people that took the 5 seconds out of their day to do that for us last time around. As I always say, as long as we're up and over 100 likes, I am more than happy to give you a full-length video that is oftentimes about an hour in length that'll go into much more details than they typically do, including trade application examples and 12-grid analysis. On the other hand, if you kind of get sick of these longer form videos, that's okay as well. Remember, if you would prefer just a 15-minute version of this video where we only look at the 4 major indices but don't get into all the other extras like the trade application examples and stuff, then don't click like. If we're under 100 likes, then I'll just give you a small 15-minute version. So I kind of let you guys decide that collectively, and you can kind of drive what it is that I'll ultimately do the next time I'm scheduled to do the video. So by the time I do the video again this Thursday, I'm going to check my tweet and see, are we up and over 100 likes? If we are, then I'll look for a trade idea. If we're below 100 likes, then I'll know that you guys would prefer just a 15-minute version and to get on with things. So anyway, thank you to the 109 of you that clicked like for me last time around, including Jeanette, including Ayakipa, including Layla, and Brian, and Arth, and Brandon, and Michelle, Kimberly, Randy, Morgan, Adrian, Anil, Irene, Camilla, Christopher, Dean, Jim, Eugene, Doug, Trunk, Pam, Michael, Sandeep, Christian, Paul, Kirk, Ken, and others. There's too many of you in here. I can't get to all of you, but I do at least like to acknowledge you sometimes just to let you know that I appreciate you. And it helps make my 3 hours that I spend on these videos a little bit more worth it if I know you guys appreciate them as well. So thank you for that. Also, while we're here, I mentioned before I was tweeting a lot about the dividend aristocrats after hours here tonight because today was a special day. Today was the day when the Standard & Poor's committee that basically builds the aristocrat list makes their rebalancing announcements. And I always try to be one of the very first people to let people on Twitter know about any changes. And today I think I was, or this year I think I was the very first person to let people know about those changes. And so to keep you up to speed here, the changes this year were Nordson, C.H. Robinson, and Smucker were added to the S&P 500 Dividend Aristocrat list. No stocks were deleted, and I thought that was kind of interesting as well because, of course, last year was a tough year for the stock market, and it was a tough year for certain portions of the economy as well. And usually when you have that combination, those are years where it's more likely than not when you end up having some companies cut their dividends and then fall off the aristocrat list. So it was good to see their stability hold up in a year like last year. And then I had a few other things here posted to Twitter that you're welcome to check out as well, including the sector breakdown of the aristocrat list and some of the other additional information that went into the returns last year, where the dividend aristocrats was only down 6% last year versus 18% in the S&P 500. So I kind of geek out when it comes to dividend aristocrats. I'm sure you guys probably noticed that about me. It's what kind of excites me about the investing universe. So whenever I have new information to share about it, I try to get that on Twitter immediately. I also try to post it in special cases to our website. So whenever there is a new update to the list, each late January when they make those announcements, I try to post that to our website as well. And remember, when I post things to the dividend growth investing portion of the blog, that is free for all of you to look at, even if you're not a premium member of Market Scholars. We offer kind of a freemium model like a lot of companies do, where some stuff is behind a paywall, other stuff is available for free. So underneath the dividend growth investing blog, you can look at that stuff for free. You can't attend my premium classes for dividend growth investing, but you can read my blogs and different things like that. And you can see off here on the left hand side under the popular recent posts, a lot of you have been clicking on that already to get the latest information, including within this article, by the way, you'll be able to see all 68 of the companies that currently make up the Aristocrat list, including the new ones, Nordson, C.H. Robinson, and Smucker. And if you don't see it under the popular recent post, the other place that you can find it on our website is by just simply hovering your mouse over blog and then clicking on dividend growth investing. And then this one, if you go to it here tonight, should be the first one up at the top of the list from a chronological perspective. So if you're interested in dividend aristocrats and want to see what types of companies have the ability to both be in the S&P 500 and have raised their dividends every year for at least 25 years in a row or more, then check out that blog post there. Also, while we're over here on the internet, we'll talk about our sector selector. So earlier today, I taught my dividend growth investing class, and we focused on the consumer staples sector, partially because dividend growth investors want a stock's price to be out of favor before purchasing it, because remember, dividend investors get an advantage that non-dividend investors do not, and that is when a stock's price goes down, its dividend yield actually becomes more attractive. Now, of course, you do have to be careful with that concept, because that only works if the dividend is safe, and obviously plenty of dividends may not be safe, and so you've got to be very careful with that. But in general, as I mentioned a moment ago, there are 68 companies that have raised their dividends for at least 25 years in a row or more, and of course that would take us back not only through the COVID time period and the 2008 and 2009 great financial crisis, but it also take us back through the dot-com era back in the late 90s and early 2000s, and some of those aristocrats will have streaks that stretch back more than 60 years. And so it's a great way to kind of battle test a corporation to kind of see whether it can survive through thick and thin from an economic perspective and still pay their shareholders more and more dividends each and every consecutive year. So in general, if you're sticking with the highest quality merchandise, you like to buy it when it's cheap if you are a long-term dividend growth investor. And this sector selector tool, which is built for trend traders, not dividend growth investors, can still be useful from that regard, because really it's the bottom of this graphic that tells you which sectors are the most out of favor right now from a price perspective, and then conversely, really what dividend yields are more attractive today than would have been a few months ago when all of those were a lot higher, or at least most of them were a lot higher in price. So it's a very interesting makeup to the sector selector this week, because for the second straight week we have the consumer bookends. We have consumer discretionary number one, consumer staples down there dead last. And that's giving us a sign of risk appetite in the marketplace. In fact, you'll notice at the bottom of this graphic, the bottom four, healthcare, real estate, utilities, and consumer staples, those are usually the bottom four that you will see when I bring up our Sector 12 grid, like I probably will here in just a little bit later on in this video. And I put them at the bottom of the 12 grid not by accident. They're there very much on purpose, because I consider those to be the most defensive sectors out there. So right now what this graphic is telling us is that the most defensive sectors are the ones that are doing the worst, at least on a relative basis. Remember, many of these may still be up in absolute terms, but they are underperforming the other sectors here currently, and that's actually a good sign for risk appetite. when the market is being led higher by consumer discretionary and cyclical areas like materials and energy, and compounders like the internet stocks within communication services, as opposed to, stocks that sell you cereal and Band-Aids and things like that, usually that's a good sign for the bullishness of the market environment that we find ourselves in. So from a sector rotation perspective, this is quite healthy behavior that we've seen here over the last, let's call it 4 or 5 weeks especially, because notice like healthcare, it was number 1 and has slipped all the way to number 8. Notice consumer staples. They were all the way up there at number 2 and have fallen all the way to dead last, right? And you can see, the utilities were quite high up here at about the 5th position and fell down to number 10. So these are all defensive areas that were doing much better on a relative basis a month or two ago that have now started to stumble, and in a lot of ways are more exciting sectors like consumer discretionary, communication services, and even a little bit of information technology have shown improvements from that same regard. Notice that consumer discretionary was down here at number 7 just about a month ago and is now number 1. Notice that communication services was dead last about a month ago and has moved its way all the way up to number 4. And then technology got as low as number 10 and it's moved up to number 7. So not as big of a move there, but nonetheless, this is a very healthy amount of sector rotation we've been witnessing here in just the last, let's call it month to month and a half, and you would classify it as quite bullish behavior, all else being equal. All right, let's go ahead and now pop back on over here to the main part of the platform, and let's take a look at some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And as you can see, we still have the bottom 2 corners as the pink charts, as was the case when I was last with you on Thursday. Now on Thursday, we also had the S&P 500 with a light pink color, but it was the 2 bottom corners that were the dark pink, and that continues to be the case today. And remember, all else being equal, that's a good thing. We want to see that for the stock market's purposes. If you want to be bullish in the stock market, you would prefer to see Treasury yields going lower and the US dollar going lower. So there's a reason that the charts look the way they do. It's not an accident, right? When the US dollar started spilling over and US Treasury yields started spilling over, notice that the stock markets, both in the United States and foreign stock markets, started going the opposite direction, right? So, from lower left to upper right versus from upper left to lower right on the dollar down below. So, if you expect those trends to hold, that's another way of saying you expect the stock market to be reasonably bullish, at least compared to what we saw in many cases in 2022 when we had the opposite conditions. Remember last year, time after time I would come into these videos and we would talk about the 2 bottom corners of this 12 grid and talk about how they were the thorn in the side of the investing community because they kept on going up. But here for the last 3 months, you can see it's been exactly the opposite, and that's exactly when we've had some really nice bullish activity out of the stock market. You'll notice here, by the way, gold had yet another great day here today. Stop me if you've heard me before. Of course, just joking, because we've been all over this move in gold, and it's been the case since basically November, and it has not slowed down. It has been a robust move. Regardless of what other people will tell you, some people poo-poo that move and say, it's just nothing, and you're too early to the move, and they'll come up with every reason why you should not pay attention to it. But you'll find that David and I don't operate that way in these videos. We tell you the truth as we see it. Now, there are going to be times, of course, that we're going to be wrong with our analysis, but when we're looking at the charts in this regard, hopefully most of you have been on the gold train for the better part of the last couple of months because we have regularly talked about it. It has not been something we've just swept under the rug and let other people talk about. This has been something that we have gone out of our way to share with you. In fact, have actually taken bullish trades in the gold universe here in these videos. So I hope some of you have benefited from that commentary. But again, another big day there out of gold. up 0.36%. You can see that it has produced yet another overbought cluster signal, but the last two overbought cluster signals really have not slowed down that trend. Remember, gold was so far out of favor last year that it can really start making its way higher here as we move forward without being perceived ridiculously overvalued, right? You can get these overbought clusters in the short term, but what that's not telling you is if you go back on like a 10-year chart here, notice that gold is not breaking to all-time highs. It was trading higher here in February of 2022, just last year, in fact, like a year ago. It was higher than where it is right now, and then you also had it higher back here in July of 2020. So while this chart looks really impressive when we look at the 3-month category here, we're not even yet to all-time highs here. So it's been really fun to see the movement out of gold, and right now I have no reason to believe that this trend is in jeopardy. If anything, each and every passing day and week makes me more emboldened that this trend is more likely to hold than not. Oil is a little bit choppier, as we've been talking about, and that's not new information either. It's stayed choppy for the last several months, sometimes good, sometimes bad, but it's kind of chopping more sideways. Currently, you'll see that oil was down here about 2% today, but because it had such a big move above the moving average, it is still able to retain its strongly bullish posture here. It also remains above a rising moving average, but when you look at the gold chart and then look at the oil chart, they don't look anything like one another. Gold looks like it has the much better trend right now, whereas oil's holding its own. It's just kind of aimless. It's meandering more sideways, and it kind of depends on the week when you're looking at it. It has not been a consistent move out of oil here more recently. In terms of the bond market, naturally when yields fall, as they did today, so the 10-year U.S. Treasury yield fell and it closed at 3.46%. On days when yields go lower, bond prices go higher. Remember the inverse relationship between those two things. So no surprise that TLT had a very nice up day. It was up 1.44% today. Foreign bonds were up about 0.43% today. And then high yield bonds managed to close in the green after being briefly in the red. They didn't close higher by much, just 0.07%. Nonetheless, the fact that they're up there near 3-month highs is another way to gauge the risk appetite of this market. And when you have high yield junk bonds outperforming other categories of bonds, it's telling you that there is risk appetite present in the marketplace. And that is telling us the same thing that we have learned from the sector rotation and other things that we've been sharing with you recently, including Bitcoin. Notice that Bitcoin erupted higher here today as well. David was back on Fox Business today with Charles Payne, so hopefully some of you got a chance to see that. But I know last time he talked about it, or was on the show, he talked about Bitcoin, and that was right when it was breaking out. And while Bitcoin was down just a little bit here today, you are still well above that breakout zone from where it was trading back here in the first week of November. So that's a good, healthy sign for the market, generally speaking, as well. Another way to determine that risk appetite is currently alive at this moment. Doesn't mean that it has to continue. It just means that that is where we currently are, right? And then up above here, you'll notice lots of bullishness with our various stock charts as well. All four of that top rung in the strongly bullish category, where you have really great bullishness out of the emerging markets. 4 days in a row to the upside for EEM. And then you'll see here that preferred stocks did manage to put in a red candle today. Remember, we've been talking about that one here in my presentations lately because of all of these days in a row. It was like 13 days in a row preferred stocks were up. And then they finally ruined that streak by having a flat day on that gray candle right there. And then for the last 2 days, they went up again. And then finally today, they had a legitimate red candle. So after basically the entire year, remember this move actually started with the second to last trading day of 2022 and then went into every trading day of 2023. Preferred stocks have been absolutely on fire here recently. Let's go ahead and take a look now at our sector 12 grid. And as we pull that up here, you can see that it is the top portion of the 12 grid that has more of the green charts. And as I mentioned previously, notice that it is the bottom rung that is struggling the most. And again, that's not a coincidence. I put them down there on purpose when I first built this 12 grid so many years ago. Those are our defensive areas: healthcare, staples, utilities, and real estate. And you'll notice that all of them have pink charts, although to be fair, real estate's starting to look a little bit better here than the other three. Notice that it's the only one of the four down below on that bottom rung that's trading above a rising moving average and actually has closed higher here the last 3 days. So it's holding up better. But the problem with real estate is in that big move higher across the broad market in the fall and winter, real estate was the big laggard there. So the fact that it's holding up better right now might just simply be because it had fallen so much to begin with and not recovered, that it can kind of stabilize a little bit better right now. Whereas areas like healthcare and staples and utilities had much more sharp ascents back there during that September, October, November time period. And so the pullbacks have been a little bit more dramatic here recently as well. Now, I mentioned the last time I was with you that consumer staples just had an oversold cluster signal, and I was talking about how rare that was because of the types of companies that are in that group, companies that are often quite boring like Walmart and Colgate and those types of companies. Well, wouldn't you know, after plotting that oversold cluster signal, we've now had 3 days in a row to the upside. They haven't been huge moves, but nonetheless, it is a way of kind of showing you that there's a reversion to the mean move taking place right now. But the expectation would be that it'll probably fail before it can cross that falling 30-day moving average, unless the risk appetite of the overall market changes. Remember, if all of a sudden some bad news comes out about Ukraine, Russia, or anything else, maybe it's the Fed that talks about bad news with having to raise interest rates more than expected or something like that, then you might expect consumer staples to kind of reassume their leadership role. But as things stand right now, where the market is more willing to take on risk, then the staples is probably not the place where you're going to get the most exaggerated upside movement. That is oftentimes reserved for some of these more speculative areas up here. I've been talking about communications for a while, mostly because communications was out of favor in 2022, but starting a few weeks ago, I had noticed that it was working its way up to 3-month highs sooner than most of the others. And now we're actually starting to see that rotation take place visually through the sector selector tool that I had mentioned earlier as well. And take a look here at communications. Communications hit a new 3-month high today if you're looking at XLC. Remember, that's where you're going to find a stock like Netflix, this company that we've talked about in my top-down trend trading classes here recently. Netflix has just been spectacular. Look at that chart. It's up, up, and away. And even some of the other internet-related companies in there have stabilized a little bit better. Now, as I mentioned earlier, Google is another big player in the communications sector, and it struggled today with some of the lawsuits and things that it's dealing with. So you never know when that will turn around. But right now, if you were to look at chart XLC right here, you would say that's one of the stronger-looking sector charts on the board, and that is a complete 180 compared to what we were talking about for most of 2022. When communications was the worst out of the 11 sectors out there. So it is interesting how quickly some of these transitions can take place. You'll also notice that technology has been a nice little break, or not a breakout, but more of a bounce off of its moving average here. You've seen some pretty good activity out of the financials, some pretty good activity out of discretionary, pretty good activity there out of materials, and even energy has been holding up pretty well. But I think right now it seems to me that communications has been the star of this movement in the markets here more recently. So keep your eye on that particular sector. Anyway, in terms of today's biggest movers in either direction, it looks like it was healthcare that was our worst performer today. It was down 0.66%. Remember when I was looking at the heat map and we were looking at things like Thermo Fisher and Edwards Life Sciences, and then I talked about Intuitive Surgical after the bell tonight. Those would all impact the healthcare sector. On the flip side here today, the best performer might have been industrials. Let me just verify here. Yeah, it looks like it was industrials were up 0.66% today. So, I had mentioned before that part of the reason for that might be some of this news we're hearing about Russia, Ukraine. A lot of the defense contractors were up nicely today. Stocks like Raytheon and Lockheed Martin, Northrop Grumman, General Dynamics, Boeing. You could even throw Caterpillar in there as kind of a reconstruction play. Some of those stocks did quite well today. So while the industrials background color remains dark pink, I would say that the price behavior looks reasonable here, and I wouldn't necessarily count it out all of a sudden. It's still trading above a rising moving average. All right, let's get into our trade application example today. And I had kind of let the cat out of the bag earlier as to what stock it was that I was going to bring to your attention when we were talking about the heat map and Berkshire Hathaway specifically. Wanted to do kind of a neutral trade here today on Berkshire Hathaway. And so what I ended up doing, as most of you are aware, if you're our premium members, remember we do these trades while the market is open, and then we send out the confirmation details and screenshots to you via Telegram if you're a premium member of Market Scholars. So most of you are already aware of this, but for those of you that just watched the free video, what I ended up doing here today was what's known as an iron condor on Berkshire Hathaway. Now remember, that's a multi-legged option strategy that includes 4 different strikes. And so you do need to oftentimes apply this to liquid securities, oftentimes to ETFs themselves like SPY. But if you do delve into iron condors on individual stocks, make sure that they are large liquid companies. And of course, Berkshire Hathaway is one of the 10 largest companies in the United States. Many of you know I am an uber fan of Warren Buffett, having gone back to the vast majority of the annual meetings for Berkshire Hathaway there in Omaha over the last 20 years. Of course, 2 years there was an exception because of COVID, and they didn't allow any spectators there those years. But otherwise, I do like to learn at the feet of Warren Buffett. Not to say that he is perfect, because he certainly is not, and he's never claimed to be. But I do think he is a good role model in this business, and is somebody who tries to go about the world of investing the right way without too many shenanigans. And so he's a guy that I've kept my eye on quite a bit over the years, and of course controlling Berkshire Hathaway and basically turning it into one of the most successful businesses America has ever seen with his helm over that company over the past 50 plus years. So Berkshire Hathaway held up quite a bit better than many of the other mega caps last year, because most of the mega caps in our universe these days are tech oriented. Berkshire Hathaway is the rare company that is not really a tech focused company. Of course, they have a huge investment in Apple, but Berkshire Hathaway itself, with its 100% owned businesses, does not have a lot of tech exposure. Instead, it owns things like Geico Insurance and Dairy Queen and Fruit of the Loom, and a lot of companies that are oftentimes perceived as old school, businesses, not the high tech oriented stuff like Nvidia or Tesla or some of those other more exciting companies out there. So it actually held up a little bit better than average last year, and of course is an area that people tend to focus on when markets get a little bit more squirrely, because they tend to think of Berkshire Hathaway as being well run. Of course, has a cash hoard that would make most of us blush, oftentimes exceeding $100 billion. So it's kind of viewed as a rock of Gibraltar type of a situation, right? When there's stormy seas out there, you need a good foundation of a company. And I think that's what Berkshire Hathaway represents for a lot of people. And you can see here it's been pretty sideways in the last several weeks as the market has kind of leaned into more exciting tech-oriented types of companies out there. Stocks like Netflix are often running all of a sudden, but Berkshire Hathaway has basically just gone sideways, right? Because this is not necessarily its moment in the sun, so to speak. So what I thought I would do is an iron condor. And you can see there's 2 lines drawn on our chart here. The month that I selected was March. The February month just really wouldn't give us the juice that I wanted out of it, so I had to go out a little bit further in time. So we're looking at the March monthly contracts. And on the top side, so the call spread that I sold was the 330 by 335 call spread. And on the downside, the put spread that I sold was the 285, 280. And so you can see that I got about $1.40 in credit for selling that iron condor on a $5 wide. That means that I'm getting more than a 30% return on risk, which is oftentimes what we shoot for with our credit spreads. I think this amounted to about a 38% return on risk. And basically, for those of you that are not familiar with this technique of selling iron condors, what we want to have happen in this case is for the stock to not have a big direction. Right? A lot of times when you're placing trades, you're either thinking to yourself, I really want the stock to go up a whole bunch, or I really want the stock to go down a whole bunch. With an iron condor, you're kind of thinking to yourself, I don't want the stock to go anywhere. I want it to be a quiet performer for the foreseeable future. And if it is, you can make money off of that. So if it stays between these two blue lines, between now and the March expiration, then I will make about 38% return on the risk that I took for this trade. On the other hand, if it does have a big move higher above 331.40 or below 283.60, then I will end up losing money on the trade. But the good news with an iron condor is it is a defined risk trade. So I know what my worst case scenario is before I place the trade. So that way, if there's a big buyout announcement or if the stock plunges on some sort of a corporate raid to their headquarters building or something crazy happens, I'm protected when I'm doing an iron condor. It doesn't mean that I won't lose money. It just means that I won't lose incremental amounts of money as the stock either explodes higher or explodes lower. So that's the other nice feature of this, because of course heading into earnings season here, a lot of times it's more helpful to have defined risk trades as opposed to risks that could be infinite. And remember, when you're short selling a stock, you have infinite risk as just one example. So anyway, pretty basic trade here today, selling an iron condor on a very boring company of Berkshire Hathaway, but plenty of liquidity there for a multi-legged option strategy, and hoping that it just kind of churns sideways here for the next 50 days or so. So that's what I had for you here tonight. I hope you enjoyed the presentation. Again, it was a pretty exciting day in the market. You might not know that by looking at the final scorecard, but right out of the gate this morning, there were a lot of fireworks there with all those crazy bids and asks that were taking place. So anyway, if you enjoyed the presentation here tonight and you want me to continue doing these long form videos with trade application examples, I ask one simple request out of you. Just click like for me there on Twitter. As long as we're up and over 100 likes, I'll give you another full-length video on Thursday. On the other hand, if you prefer the shorter form videos, only 15 minutes in length with no trade application example, then don't click like for me on Twitter. And if we're below 100, then we'll stick with that route. So we'll let you guys decide there. Regardless of what you end up doing, I appreciate you checking out tonight's video. I wish you all the best of success with your trades and your investments. Goodbye for now.